We are going to discuss about the risk and return of a portfolio of investments. So, portfolio of investment means you have investment in more than one assets. For example, if you buy only one share of one particular company, you are not holding a portfolio. But if you invest in more than one shares of different companies, then you have an investment portfolio. Different investors may have a very big portfolio having 15 stocks, 20 stocks, 40 stocks. Okay, it depends on their degree of diversification into different securities. Also, the business organizations may have portfolio of investments in several investment projects. To get the idea about the risk and return of a portfolio of investment, we need to understand how can we estimate the risk of a portfolio and also how can we estimate the return of a portfolio. To illustrate, let us assume a two-stock portfolio where we are investing $50,000 in two assets. One is the high-tech and another one is the collections. So let us assume that these are the shares of two companies, shares of high-tech and shares of collections. We are investing 50,000 in high-tech share. We are investing another 50,000 in collections. So our total investment is 100,000. So if we talk about the percentage investment, then we can say that we have invested 50% in high-tech and 50% in collections. Now, how can we estimate the expected return of the portfolio and the risk of the portfolio? Estimation of the portfolio return is very simple. It is the weighted average of the returns of the portfolio's component assets. That means if you have already calculated the expected return of high-tech and also the expected return of collections, then what you can do, you can take the weighted average of these two returns to get the portfolio return. You know that the measurement of risk is done by calculating the standard deviation. Because we are thinking about the risk associated with future returns, so it is little more tricky and it requires that new probability distribution for the portfolio returns to be constructed. In fact, if you know what are the probability distributions of the returns of high-tech and collections separately, then from these two probability distributions, you can also find out the probability distribution of the possible future returns of the overall portfolio. We will illustrate that. So at first, let us focus on the estimation of return, the expected return of the portfolio. If we give a notation RP hat as the notation for portfolio expected return, then RP hash will be equal to the weighted average of the individual assets return, the assets that are in that portfolio. So you can see RI hat is the return of the individual asset I, and WI is the weight of investment for the asset I. In our example, we have two assets, so we have the value I equals 1 and 2. In our case, I equals 1 and 2 because we have only two assets. So let us think about the first asset. The first asset has 9.9% of expected return, and we have invested 50% in this asset. So how can we construct this? W1R1, 0.5, this is the weight of the asset 1 in the portfolio, and 9.9%, this is the R1, that means the first asset's expected return. Similarly, for the second asset, the expected return is 1.2% and the investment percentage in the second asset is 0.5, that means 50%. So if we do this calculation, then we get the portfolio expected return, which is 5.5%. Probably you can understand that in order to estimate the portfolio expected return, at first you have to estimate the expected return of the individual individual securities or individual investments. And you also need to know the percentage of investment in each of the securities or assets in the portfolio. In our example, it is a very simple example. We have invested 50% in one and the other 50% in the another. Okay, so this result is similar to simple average. So if you just take 9.9 plus 1.2 then divide by 2, you will get the same result. But sometimes you may even invest more in one asset and less in the other asset. For example, 60% in first one and 40% in the second one. In that case, the result will not be equal to the simple average of the two returns. So in that case, you will have to multiply by 0.6 with 9.9% and 0.4 with 1.2%. Now let us discuss about estimating the portfolio expected return using another method. In the previous case, let us go back and see. In the previous case, we have calculated the expected return of individual securities separately, and then we have come up to this stage of calculation. What we can do, instead of calculating the individual security expected return first, we can start straightforward for the portfolio. How can we do that? If we know what will be the possible returns in different scenario of the economy for the first security and also for the second security, then what we can do, we can calculate the portfolio return for each and every scenario separately. So how have we got this minus 2.5%? We have taken the weighted average of these two. That means 50% of minus 29.5% plus 50% of 24.5% equals minus 2.5%. Okay, similarly, we have taken 50% of 9.5% plus 50% of 10.5%. Then we have got 0.5% for the portfolio return if the below average condition of the economy comes up. Okay. Now let us look at another example, 12.5% and minus 1%. This is if the economy continues its average state. So you can see in this case we have 12.5% from the first one and 1% from the second one. So what we can do, because we know that we have invested 50% in one and 50% in two, so 50% times 12.5% plus 50% times minus 1%, we will get 5.8% if the economy continues its average state. So we do this calculation for 5 states here, and we get the probability distribution of the portfolio returns. Now what we have got? We have got the probability distribution of the returns of the whole portfolio. Now we do not have to do the weighted average anymore. What now we can do? We can just multiply the probability of each state and the return if that states occur, plus the probability of the other state and the return if that state becomes true. The probability of the other one times the return, probability of the other one times the return, and the probability of the last one and the return if that state occurs. So you can see the calculation. The probability 10% times the portfolio return if that situation occurs. That means if the recession occurs. Okay. Similarly, if you do the calculation for all of these, then you will get the expected return of the portfolio, which is the same as we have got before. So it is your choice which method you use. Now let us talk about the estimation of risk of the portfolio. How can we estimate the risk of the portfolio? You know that the method that we use is standard deviation and coefficient of variation. So if you want to estimate the coefficient of variation, you need to calculate the standard deviation. So how can we calculate the standard deviation? This is the same process that we can use for individual security. Whenever we have the probability distribution of returns, we can easily calculate the standard deviation. Let us look back to the probability distribution. We can clearly see that the probability distribution is here, and we also got the expected return calculation. So what we can do, we can estimate the standard deviation of the portfolio. We already know what is the formula for calculating the standard deviation. This is the square root of sum of all the squared deviations from the expected return. So you can see our expected return is 5.5%, and we have the different possible returns in different economic state. So what we can do, we can calculate it very easily, the probability of the first state and the return if the first state occurs minus the expected return and squared. You have to square that. So if you do that, then you get the first item. Do the same for the second state of the economy, third state of the economy, fourth state of the economy, and fifth state of the economy. And after summing all these up, then take the square root. Take the square root of the result. You will get the standard deviation 4.6% for this example. And you can use this 4.6% to calculate the coefficient of variation. What you have to do, you have to divide the standard deviation by the expected return of the portfolio, and you will get the coefficient of variation for the portfolio. This is how you can calculate or you can assess the risk of the portfolio. Now I want to show you a very interesting finding. If you calculate the standard deviation of these two securities separately, HT and collections, okay, the first one and the second one, then you will find that the standard deviations are 20% for the first one and 11.2% for the second one. And if you take the weighted average standard deviation of these two securities, then you will see that the standard deviation, weighted average standard deviation is 15.6%. But interestingly, after calculation of the portfolio standard deviation using the procedure that I have just discussed, we have got it is 4.6%, which is quite low. 4.6% is lower than the weighted average standard deviation of the individual stocks, individual securities standard deviation. This is very interesting. What does that mean? It means that if you invest in the first security at one point of time, and if you invest in the second security another time, and if you calculate the risk that you will face separately, if you think these two risks separately, the total will be more than the risk when you invest in these two securities together as a portfolio. So forming a portfolio is better in terms of risk. The portfolio will result the reduction of risk. That is the interesting finding. So we can say that the portfolio provides the average return of component stocks but lower than the average risk. We have seen that the return is very simple. It is the weighted average return, but the risk is lower than the weighted average risk. Okay, you can see the weighted average risk is 15.6%, whereas the actual risk of the portfolio is 4.6%. So in case of risk, we are getting some benefit. Our risk is significantly reduced when we invest in more than one securities together. So why does it happen? That is a very interesting question, and the answer is because of the correlation between the two stocks. Okay, it can sometimes be negative. If it is negative, if the correlation is negative, the risk will be reduced significantly. But if the correlation is less than 1, and even if it is positive, still the risk will be reduced in case you invest in a portfolio. That is the diversification benefit. That is the diversification benefit. So if you want to express it in a different way, you can say that, well, when you invest in two stocks together, sometimes it happens like if the return, the loss of one security is covered up by the profit from the other security. So what happened? The overall variability of the portfolio return actually reduces. This is the benefit of diversification. So if you diversify your investment, that means instead of investing all your money in one particular security, if you invest the money in more than one securities and form a portfolio of investment, then what will happen? Your overall risk will reduce, because the profit of or the gain of one security will help you to minimize the risk of the other security. This is why combining stocks in a portfolio generally lowers risk. We have further discussion on this issue. Let us look at this graph. The first graph, let us look at the first graph. We have time on the x-axis and we have the rate of return on the y-axis, right? So you can see we have two stocks. One is W and another one is M. Okay, you can see the pattern of return. You can see the return of W has quite very high variability. The lowest is close to 12%, minus 12%, and the highest is close to above 30%. And same variability for the green one, the M. But the difference is when W gives you loss, M gives you profit. So ultimately, if you invest in both of these two, that means if you invest in portfolio WM, where you have invested 50% in W and 50% in M, what will happen? The loss of W in 2015, for example, will be covered by the profit of M. As a result, the portfolio return will be the green line. You can see this is the line. There is no variability at all. So you have no risk of this portfolio. The return is not as high as 30%. The loss is not as low as minus 12%, but you have moderate return with no variability at all. This is an extreme example, because in this case, the return of W and return of M has perfectly negative correlation. Now, when the return of W decreases by 10%, the return of M increases by 10%. So this is the example of perfectly negative correlation. So in this case, what happened? Your portfolio will not have any risk at all. Although this example is an extreme one, but it helps us to understand the diversification effect when you invest in more than one assets in a portfolio. If you look at the probability distribution of the return, you can see that the rate of return, if you hold it separately, it ranges from minus 10% to close to 40%, and it has an average of 15%, but it has great variability. It has a great variability. But look at the return of portfolio WM, where you combine W and M together. So you have the same average return, but you do not have any variability at all. Okay, so this is the example of extreme level of diversification when the return of the assets have perfectly negative correlationship. Another example, if the returns are perfectly positively correlated, you can see when stock M, the return of stock M increases, return of stock M dash also increases. Okay, so the increase and decrease of the two stocks happen together. Okay, it is not in the opposite direction, it happens in the same direction. So in that case, our correlation is perfectly positive correlation, that means +1. So in that case, you will not get any diversification. The portfolio will also have the same level of risk. So in that case, both are extreme cases. Having correlation of -1 and having correlation of +1, these two are extreme cases and very difficult to attain. But if you can attain the perfectly positive correlation, then your portfolio will not have any diversification, and the risk of the portfolio will become the weighted average risk of the return of M and the return of M dash. Now let us talk about non-extreme correlation between the two assets. For example, correlation is less than plus 1 or greater than minus 1. For example, plus 0.35. In that case, think about W and Y, the two stocks. They do not have perfect correlation in any way, either plus or minus, but they have a correlation of 0.35. So what happened when let us think about 2016, the return of W has increased up to close to 33% or so, but the return of Y has not decreased that much. It has not decreased that much as it has decreased in 2017. So you can see still we have got some diversification benefit. If we look at the curve for the portfolio WY, we can see that the variability of W and variability of Y has been combined, and it has less variability compared to the variability of the return of W and variability of the return of Y. Okay, if you look at the probability distribution, you can see if you held the stocks separately, you will definitely get the probability distribution like this. But if you hold together, if you invest in W and Y together, then you still have some probability distribution. It is not like the case of perfectly negative correlation, but still the variability will be lower. Okay, the variability will be lower compared to having these two stocks separately. So in fact, the portfolio standard deviation decreases whenever you add another stock in your portfolio, because there is a very little chance that another stock, another security will have perfectly negative correlation or perfectly positive correlation with the existing portfolio. Normally it will be in between plus 1 and minus 1, so it will contribute to some reduction of the portfolio standard deviation. Okay, so expected return will remain relatively constant, but what we want to focus on the standard deviation. So ultimately you will get more and more diversification benefit if you keep adding more and more stocks. But remember, the benefit will not come indefinitely. Okay, the more stocks you add, the more will be the benefit, but the additional benefit will be lower with further addition. So what will happen? Eventually the diversification benefits of adding more stocks will dissipate, and for large stock portfolio, sigma p tend to converge to a certain level which we call non-diversifiable level. That means after adding quite so many numbers of stocks, your benefit of diversification may not increase as much as it has increased during the initial level of addition. For example, when you have added the first stock or second stock or fifth stock, your diversification benefit was quite good amount of benefit. That means risk diminished largely. But for example, if you go beyond 40 stocks, you will not get any significant reduction of standard deviation at that point of time, but it will reduce even if it is negligible. To understand that, let us look at a graph. The x-axis is showing the number of stocks in the portfolio, and y-axis is showing the portfolio risk in terms of sigma, the standard deviation of the portfolio, sigma p. So let us look at the addition of the second stock. If you add the second or third or fourth, something like that, if you add the stocks at the initial level, if you keep adding more and more stocks in the portfolio, you will see that the portfolio risk, total standard deviation of the portfolio will reduce significantly. But if you keep adding more, it will still reduce, but the reduction will not be that much like what was there at the initial level. Okay, so it will decrease at a diminishing rate, and you will see that after certain level, the reduction of risk will be negligible. Okay, and it will never cross a certain level, and this is the level of non-diversifiable risk. So we can divide the total risk into two components. Okay, one is the diversifiable. Okay, this component, let us focus on let's say this number of stocks. So for this portfolio we have total risk of this amount, and up to this amount of risk is non-diversifiable. Okay, this is sometimes called market risk or systematic risk or non-diversifiable risk, same thing. And this component is called, this portion is called the diversifiable risk. Now let us think about the market. You know that investors should get risk premium for taking additional risk. That means they should get more return for taking more risk. Now the question is, should the investors get additional return or risk premium for all these risks? That means the total amount of risk, or they should get only for the non-diversifiable or systematic or market risk? That is a very important question. We have to think about that.